Hello, I'm Ryan O'Connell, and we're going to look deeper into the topic of the carry trade, which is pretty simple once you get your mind wrapped around the mechanics of it. The carry trade works if uncovered interest rate parity does not hold. And what we mean by works is that this strategy can generate an arbitrage profit. Now, what is the strategy? Now, if you think back to what the uncovered interest rate parity says, which we'll refresh on the next slide just in case you've forgotten, but it's basically saying that once you account for the differences in forward rates and spot rates and interest rates, there should be no way to just move money into a higher interest rate currency, achieve that higher interest rate, and then move it back into your previous currency. Because of the way that the spot rate and the forward rate mechanics work, that should not be a possible arbitrage strategy if the spot rate turns into the forward rate based on the exchange rates between the two. But this carry trade strategy is basically going to work if that spot rate doesn't turn into the forward rate in the way that it was expected to. So the concept is that basically you'll borrow at the low yielding currency, so the currency with the lower interest rate, because it's cheaper to borrow at that lower rate. Then you'll exchange it into the high yielding currency at the spot rate. And then once you have the currency into that higher yielding currency after you've exchanged it, you'll invest the high yielding currency at the higher rate. So this is to the part where if the forward rate turned into what we had expected it to be at the initiation, there would be no arbitrage profit. But basically the strategy will work if the currencies don't appreciate or depreciate the way that they were expected to. So let's keep going. So after we invested the high yielding currency at the higher rate, then we'll unwind the investment at the end of the time period. So t equals 1 is 1 year from now. And then we'll exchange the high yielding currency at the spot rate at that time. So, right, it's 1 year after we initiated the initial exchange into the high yielding currency. So we're now 1 year in the future, exchanging at that spot rate. And then we will repay the low yielding loan, the loan that we took out all the way at step 1. And this strategy profits if the depreciation of the high yielding currency is less than expected, or if the high yielding currency actually ends up appreciating against the lower yielding currency. This strategy has tended to be profitable more often than not, but if the adverse rate movements happen, then it can be extremely unprofitable. So the risk is really that there's an adverse movement in the exchange rates where perhaps the high yielding currency depreciates even more than had been expected initially. Then you would really lose on the carry trade. Let's map out the carry trade a little bit more and also talk about the profit that can be generated from the carry trade. I mentioned that the carry trade had to do with uncovered interest rate parity or uncovered IRP not holding. Now remember that the uncovered interest rate parity is basically this formula where we have 1 plus the nominal interest rate for the domestic currency on the left side of the formula. That should be equal to the right side of the formula, which is the current spot exchange rate between the foreign and domestic currency at time 0, so right now today, multiplied by 1 plus the foreign currency's nominal interest rate, multiplied by 1 divided by the spot exchange rate between the foreign and domestic currency at the end, so big T is maturity, right? So basically we're saying that investing at our current domestic lower rate currency should be equivalent to exchanging our domestic currency into the foreign currency today, investing at the foreign currency's rate, and then converting back to our domestic currency at the end of the period. Those two should be the same. If they end up being the same, then uncovered interest rate parity holds and the carry trade is not profitable. However, if they do not hold, So the carry trade is only really profitable if the uncovered interest rate parity does not hold, these do not equal each other. Then we could start to look at how we would calculate our profit on the uncovered interest rate parity. Then we could look at how we would calculate our profit on the carry trade. And we can see that profit is going to be this symbol right here. It is equal to the nominal foreign interest rate minus the nominal domestic interest rate. The difference between these two gives us the nominal interest rate differential plus the change in the asset value plus the change in the currency's value. So if we add all three of these together, then we can find our profit on the carry trade. Now let's implement this with a practice problem. We're told that if two countries have an interest rate differential of 6% and the higher rate currency appreciates by 3%, profit from the carry trade in these currencies will be closest to. So let's think about this for a sec. They have a 6% interest rate differential between two countries. We can say country A and country B. So just as an example, their interest rate differential is 6%. So that means that one should be 6% higher than the other. So let's just do an example interest rate. Let's say A's interest rate is 6% and B's interest rate is 12%. This reflects our differential right here. Normally, we would expect for the higher rate currency to depreciate, not appreciate. But in this case, the higher rate one's going to appreciate. So what is going to be our profit? Well, the one component is that basically right now we're going to borrow at the 6% and then we'll lend at the 12%. So this right here, just from this borrow and lending, we're lending at 12%, we're borrowing at 6%. That gives us that 6% ROI right then. Now, if the uncovered interest rate parity had held, we'd actually see the higher rate currency depreciate by 6%. But that's not what happened. So if it depreciated by 6%, then we'd subtract 6% from the currency exchange rate changes, but it actually went up 3%. So our profit from the exchange rate change, it's actually going to be 3%. So we made 6% on our lending and borrowing and 3% on our profit from the exchange rate change. So our total profit is going to be equal to 9%.
The video you just watched is a part of UWorld's comprehensive CFA programs. Get 25% off any of these products using the promo code Ryan25 and the link in the description or the pinned comment. Thank you for watching.